It's 10:30 at night. The kid is finally asleep. You're in bed with your phone and you open your banking app to do the math you do every week. Mortgage autopay hits Thursday, daycare pulls Friday, that car insurance payment you keep forgetting about is next Tuesday. So you shuffle money between checking and savings like a shell game, trying to make sure nothing bounces and nothing overlaps. Here's the thing that should bother you. Last week you spent 45 minutes researching the best $35 air filter for your HVAC system to save 12 bucks. But last month, without flinching, you renewed a $400 a month car lease because the payment fit the budget. You're hyper-rational about the small stuff, completely unexamined on the decisions that actually determine whether you build wealth or stay stuck. There's a dollar amount in savings where that pattern breaks, where the shell game stops, where you stop optimizing air filters and start optimizing your actual life. And that number is lower than you think. Most people think wealth building is a smooth, linear climb. It's not. There are thresholds where the physics of your financial life fundamentally change. And the first one, separating people who build real wealth from people who run in place for decades, is $20,000 in liquid investable savings. It's not the math that changes at 20,000, it's something in your brain. And that psychological shift is worth more than the money itself. I'm going to show you the brain science behind why this number changes everything, give you a formula to calculate your personal version of this threshold, and walk you through 3 steps to stay above it. If you're trying to build real financial momentum, subscribe. This channel is built for exactly that. Think of every dollar you save as runway. When a plane is on a runway, it's burning enormous fuel just to move forward. Most of the energy goes into fighting inertia, not flying. But there's a speed where the wings generate enough lift to leave the ground. Below that speed, you're just a very expensive, very loud car. Above it, you're airborne, and the same engine that was barely keeping you moving is now carrying you at 500 miles per hour. $20,000 is takeoff speed for most American households. Below it, every dollar goes to fighting friction. Bills, emergencies, minimum payments, survival. Above it, dollars start generating lift. Returns, options, confidence, leverage. Vanguard research found that $2,000 in emergency savings increases financial well-being by 21%. Push that to 3 to 6 months of expenses, which, for a household spending roughly $3,300 a month, lands right around $20,000, and you add another 13%. That's a 34% total improvement from one threshold. Here's where the math gets exciting. Say you're saving $1,000 a month at an 8% average annual return. Your first $20,000 takes roughly 19 months. Your second $20,000 takes about 17 months. Same effort, 2 months faster, because now your first $20,000 is generating returns alongside you. By the time your portfolio hits $100,000, the next $20,000 takes only 14 months. At $400,000, the next $20,000 takes around 9 months. Same $20,000, a fraction of the time. Once you're airborne, the same engine covers vastly more distance. You might be thinking, the compound math is nice, but I'm 36, not 22. Does this actually work for me? Meet Dave. 36. Household income $110,000. 62,000 in a 401k, 8,000 in savings, a mortgage, a car payment, daycare. Dave and his wife Sarah do one thing differently this year. They automate an extra $400 a month into savings until they hit a $20,000 liquid cushion. That takes about 2.5 years, starting from 8,000. Dave stops cashing out his annual bonus to cover emergencies that aren't really emergencies. They're just unplanned expenses his cash cushion now absorbs. That bonus, $4,000, goes into his 401k instead. Combined with his existing contributions, his invested assets cross 100,000 within a few years. The savings habit didn't just build the cushion, it rewired how Dave and Sarah talked about money. The conversation stopped ending in vague stress because they finally had a number they were aiming for and a system hitting it. A Harvard Business Review study found that employees with greater financial security negotiate salaries 11% higher than equally qualified peers without it. For Dave, that's roughly $12,000 a year in additional income, not from a side hustle, from the confidence that comes from having Runway. Here's the danger nobody talks about. The most dangerous moment in your financial life isn't when you're broke. It's the month after you hit a savings milestone. Researchers call it the licensing effect. Past good behavior gives your brain permission to indulge. You saved 20,000. Your brain says you've earned a new car. You've been disciplined for 18 months. Surely you deserve that kitchen renovation. This is the exact moment the consumer finance industry is waiting for. Auto lenders, credit card companies, home improvement financing, they don't market to broke people. They market to people who just prove they can make payments. The credit score you built while saving generates targeted offers for 0%. Intro rate cards, pre-approved auto loans, lifestyle upgrades wrapped in the language of "you deserve this." Your discipline is their customer acquisition signal. So how do you protect yourself from yourself? 3 steps. Step 1, calculate your personal runway number. Take your monthly essential expenses: mortgage or rent, utilities, insurance, groceries, minimum debt payments, daycare. Not your total spending, your survival spending. Multiply by 6. That's your runway number. For most people watching this, it lands between $15,000 and $25,000. If your current savings already cover 6 months of essentials, move to step 2. If not, this is your single financial priority until it does. Not investing more. Not paying extra on the mortgage. Runway first, everything else is noise. Step 2. Automate the wall between runway money and growth money. Once your runway number is hit, every dollar above it gets automatically routed to invested assets. 401k up to the match minimum, then Roth IRA if eligible, then back to the 401k or a taxable brokerage account. If you're not getting the full employer match, fix that tonight. An employer match is a 100% return on day one. Runway money sits in high-yield savings and never gets invested. Growth money gets invested and never gets touched. 2 different pools. 2 different jobs. Step 3, install a 48-hour milestone rule. Anytime you hit a milestone, 20,000, 50,000, 100,000, you are not allowed to make any purchase over $500 for 48 hours. Write it down. Celebrate it out loud. Tell your partner. Then wait. This isn't willpower. This is a system designed to interrupt the licensing effect at its trigger point. The impulse to reward yourself peaks in the first 24 hours and drops significantly by 48. Remember that image we started with? You, 10:30 at night, banking app open, playing the shell game. That game doesn't stop because you make more money. It stops because you build enough runway to leave the ground. Most people spend their entire financial life taxiing, moving, burning fuel, going somewhere, but never lifting off. The plane looks busy, but it never flies. $20,000 isn't a destination. It's the moment the wheels leave the ground. The goal was never the money. The goal was the options. The ability to stay at your job because you want to, not because you have to. The ability to take a risk because you can survive it failing. $20,000 doesn't buy you freedom. It buys you the ability to stop being afraid. And that changes everything. Open your banking app right now. Calculate your runway number, monthly essentials times 6. Drop that number in the comments. A number in your head is a wish. A number written down is a plan.